Hello and welcome to this video. Today I will show you everything you need to know about moving averages, how moving averages work, what it is, what the EMA is, what differentiates the EMA from the SMA, and how you can use moving averages for your trading to make your trading more effective. All you need for this video is TradingView. The link is in the video description. I'll repeat once more what you'll be able to do after this video. You will know how to determine the trend using the EMA. You will know how to use EMA crossovers to your advantage and how to successfully trade EMA dynamic support. At the end of the video, I'll show you a secret way to avoid sideways markets using the EMA. So let's get started. First, we click on indicators. Then we type in EMA and click on moving averages exponential. Then we go to settings, make the moving averages a little thicker and change it to a color of our choice. Change the length to 200. A moving average is a tool used in technical analysis to calculate the average price of an asset over a set number of periods. In this case, we are using 200 periods. Each period corresponds to one candle on the chart, which represents a specific time frame, 1 hour, 1 day, depending on your chart settings. The moving part refers to how the average is updated continuously. As new candles form, older ones are removed and the average recalculates. This creates a dynamic, constantly shifting view of the asset's average price over time. The 200 period moving average is commonly used because it helps to filter out short-term price fluctuations, providing a clearer view of the overall market trend. If the price is above the 200 period moving average, it suggests the market is in an uptrend. Conversely, if the price is below it, the market may be in a downtrend. Here's another example. The chart is above the 200 EMA, which suggests that we are likely in an upward trend. This indicates that we should look for long opportunities as we expect the price to continue rising in the same direction. Here's another example. If the chart is positioned below the 200 EMA, it indicates that we are probably in a downtrend. In this case, we would focus on looking for short setups as we expect the price to keep moving lower. Now I will explain the difference between the exponential moving average and the simple moving average and why you should avoid using the simple moving average for trend determination. The simple moving average is calculated differently from the exponential moving average. The exponential means that the most recent candles have a greater impact on the exponential moving average, making it more responsive to price movements. In contrast, the simple moving average treats all periods equally, which means it reacts slower to recent price changes. Now I will show you something very important. As I just explained, if we are above the 200 period exponential moving average, we are in a bullish trend, which means we should look for long opportunities. If we are below the 200 period exponential moving average, we are in a bearish trend. And in that case, we should focus on looking for short opportunities. But just because we break through the 200 period exponential moving average doesn't mean we are immediately in a trend reversal and should start looking for buying opportunities. It could very well be a fake out. A fake out occurs when we break above the 200 period exponential moving average, but then quickly fall back below it shortly after. However, there is a relatively simple way to identify these fake outs and prepare for them. When we break through the 200 period exponential moving average, in this case on the 15-minute time frame, we move to the next higher time frame, meaning the chart will now show us 30-minute candles, and we wait. If we break the EMA on the higher time frame as well, we can be fairly confident that we are bullish on the 15-minute time frame. However, if we don't break the EMA on the higher time frame, it's a fake out, and we should not look for buying opportunities. Here, we clearly did not break the 200 period exponential moving average on the higher time frame. Therefore, it was a fake out on the 15-minute time frame. Here we have another example on the 1-hour chart. We break the 200 period exponential moving average, then move to the higher time frame, which in this case is the 4-hour chart. We check and see that we have indeed broken the EMA. This means it is highly unlikely to be a fake out, and we can now start looking for buying opportunities. Now, let me explain EMA crossovers. First, click on Indicators again, type in Exponential Moving Average, and click on it. Once it appears, add it to your chart. After that, click on the settings of the newly added EMA and change its length to 100. This blue EMA now represents the last 100 periods on your chart. Now, if the blue EMA, the 100 EMA, crosses the 200 EMA from top to bottom in this example, it could be a bullish signal. This indicates that the shorter term candles, or the last 100 candles, are showing more strength and bullish momentum than the longer term candles, which represent the last 200 periods. Now, we set our stop loss just below the crossover. I know this is quite far, so this strategy is more suitable for advanced traders, and I'm not a big fan of it. The stop loss represents the maximum loss we are willing to accept on this trade. Then we set our take profit at a risk to reward ratio of 2:1. This means that if the trade goes in our favor, we would make twice the amount of our risk in profit. For a bearish crossover, when the shorter term EMA, 100 EMA, crosses below the longer term EMA, 200 EMA, it signals a potential downtrend. This is a different trade setup than the bullish one, and in this case, we would focus on looking for short positions. We would set our stop loss above the crossover point and our take profit at a 2:1 risk to reward ratio, meaning we aim to make twice as much as our risk amount if the trade goes in our favor. Now, let me show you how to use the 200 EMA as dynamic support and resistance. What does this mean? Support and resistance are zones where the market encounters resistance or support and then continues in the prevailing trend. Why dynamic support? Dynamic because the EMA is always moving, and thus its support zones change constantly. In this example, if we break through the 200 EMA from below, and then the next candle pushes back down below the EMA, we have a potential short signal. At this point, we could set our stop loss above the last swing high. This method helps us take advantage of market movements while using the dynamic nature of the EMA to adjust our support and resistance levels. Now we have a bullish signal. Here we break through the moving average from top to bottom and then immediately break through it again. This means that the moving average is acting as support. We can set our stop loss at the last swing low. Now let me show you a trick. You can set your take profit at a risk to reward ratio of 1. When we reach this take profit, move the stop loss to break even. What does this mean? We move the stop loss to 0, the entry point, and set the take profit to 2. This way, we now have a risk-free trade from this point forward. Now let me show you how to avoid side markets in trading using multiple EMAs. These multiple EMAs are called an EMA ribbon. There are different variations of the EMA ribbon, but my favorite variation consists of the following EMAs: the 25 EMA in red, the 50 EMA in white, the 100 EMA in blue, and the 200 EMA in yellow. This combination is better for trend analysis because it helps you visualize the market structure more clearly and avoid trading in choppy, sideways markets. The different EMAs provide a clear representation of short, medium, and long-term trends, helping you determine when the market is trending strongly in one direction or when it's moving sideways and lacking momentum. What we can observe here is that all the EMAs are pointing in different directions. For example, the 25 EMA is pointing down, while the 200 EMA is still pointing upwards. The 25 EMA is also below the 50 EMA. The EMAs are very close to each other, unlike in a strong trend where they would be far apart. This proximity and the fact that they are pointing in different directions suggests that we are likely in a sideways market. As beginners, we should avoid taking trades in this situation. Guys, that's it for this video. I really appreciate you watching. Feel free to leave a like and follow the channel. Of course, you can also trade crossovers on shorter time frames, for example, using the 26 EMA and the 50 EMA. However, keep in mind that this can lead to more false signals, and crossovers are generally more suited for advanced traders. If you have any questions, just ask in the comments and I'll be happy to help. See you in the next video.